In this current section, we're going to be looking at the change of basis for tax. Now, this is going to affect businesses who have a year end other than either the 31st of March or the 5th of April, or those in the early years of trade. Now, the idea of this is that it's going to simplify the allocation of the trading income into tax years. However, the reality of the matter may not be quite as straightforward as this may first seem, and we will discuss this a little bit later as we move through this part of the presentation. So the rules that we've got for changing the basis of tax is going to apply from the tax year 2024-25. So that is the tax year that ends on the 5th of April 2025. However, the previous tax year, i.e. that one ending on the 5th of April 2024, is going to be a transitional year. And we will have a look at what this is going to mean for practices very shortly. But ultimately, what is going to happen is that regardless of what your year end is that practices and partners are going to be taxed on their profits that arise within the tax year. So that means that you'll be taxed on profit either up to the 5th of April or 31st of March each year, irrespective of what your account year is. Now, there are reasons why practices have different year ends other than the 31st of March. Historically, practices may have had a year end which ends on one of the quarter dates, and this coincided with when the payments used to be made under Red Book amounts. But this table shows you when the account profits are actually taxed. And it's the year end which determines the tax year that you fall into. So, for example, if a practice has a year end of the 31st of December 2021, that will fall into the 2021-22 tax year. The tax return filing deadline for that year is the 31st of January 2023. So that gives you 13 months between the time that you prepare the accounts and when the tax return needs to be filed. If a practice has a year end of 31st of March, then there are 10 months between the year end and the filing deadline. However, as you can see for this table, year ends, for example, April, June, or September, you have longer time to be able between when the profits are earned and when you actually pay the tax on them. Particularly for an April year end, there's a whole 21 months between when the profits are earned and when the tax is actually paid on those profits. And the impact of these changes is actually going to be accelerate that time period between when the profits are earned and when the tax is actually paid on them. Now, the advantages that we currently have with practices who have a year end other than the 31st of March is the length of time that we've got between knowing when the profits are generated and when the tax is paid. So it means that we can provide details of estimated tax payments to our practices a long way in the future. So it means that they can be prepared for the tax payments and to make the appropriate levels of savings. We can also look, so for example, for a year under the 30th of April, the April 2023 accounts should be prepared by the time the tax return for 2022-23 is prepared. And that means if there is a change in profits, so for example, if profits have reduced, it means that we can have a look at reducing the payments on account for those partners, if that would be applicable. So that's where we're at with the current basis of taxation. So profits are taxed in the accounts year ending within that tax year. Now, before we look at the changes for the practices, another thing that I just want to have a look at is overlap. Now, overlap profits are generated at a fixed point in time. So for any partners who were in partnership at the time when self-assessment started in the mid-90s, they will have generated their overlap profits in 1996-97. Or probably more commonly, where you have had partners joining a partnership subsequently to then, and obviously with the partnership with a non-March year end. So what this means is that in the first couple of years of self-employment, there are very specific rules laid down about when the profits are actually taxed. And there will be an element of the profits that are taxed twice, and these are known as the overlap profits. And the overlap profits can be deducted when a partner either leaves a practice or when the practice changes their year end. And it's important, obviously, the longer ago that the overlap profits were generated, then the circumstances that an individual may have had may have changed between when the overlap was generated and when the overlap profits are actually used. So, for example, if overlap was generated quite a long time ago, it is quite possible that profits for that individual partner may have actually increased over the years. Or it is possible that a partner had generated overlap profits when they may have been working more sessions. So each partner's overlap profits will vary on an individual basis. And we'll have a look at an example of how overlap profits are actually generated. So in our example, we've got Dr. A. Now, Dr. A is joining a practice as a partner on the 1st of July, and the practice prepares accounts up to the 30th of June every year. And prior to joining the practice as a partner, Dr. A was a salaried GP. Now, looking back at the previous slide that we had here, normally with a June 2022 accounts year end, the profits would not be taxed until January 2024. However, the HMRC rules are for new joiners for a business that doesn't have a March year end, is that they want those in profits taxed as early as possible. So in this example, Dr. A is joining the practice on the 1st of July. So in the first tax year, i.e. 2021/22, Dr. A will be taxed on profits from the 1st of July 21 to the 5th of April 2022. So the reality of this means that the June 2022 accounts will be prepared and the profits for Dr. A will be prorated for that period. So, and Dr. A in that year will have salaried income to 30th of June, and that income will be included in their tax return for that year. Now, for the year 2022/23, we have a full account year in there, and it coincides with Dr. A having 12 months worth of partnership income. So in 2022/23, Dr. A will be taxed on the profits that arise from the 1st of July 21 to the 30th of June 22. So you will see from this that the profits that were generated from the 1st of July to the 5th of April have been taxed twice. So these are known as Dr. A's overlap profits. And these are the profits that will be deducted either when Dr. A retires from the practice or if the practice changed their year end. So what is going to be happening then for the changes of the basis of the taxation? The difference is that businesses are going to be taxed on profits which arise in the tax year. As I mentioned earlier, that is effectively going to be up to the 5th of April each year, although HMRC will allow an apportionment up in months up to the 31st of March, if that can be done consistently. And that is probably the most straightforward thing to actually do. Now, there is no requirement for any business to change their year end, although it may be something that does need to be considered. And these changes are something that we will be discussing with our clients. Indeed, with the impact of the tax position for the partners, and having a discussion about the year end and the impact that it will actually have on the partners and on the practice. So, as I said, you don't have to change the account year end, but it does mean that we're going to have to effectively apportion any profits between the tax years. So, in this example, a practice has an account year end of the 30th of June. So for the tax year end 2024-25, we will need to report profits for the 12 months to the 31st of March 2025. So what this means is that we're going to have to take 3/12 of the profits from the June 24 accounts, so i.e. those profits from April 24 to June 24, and then 9/12 of the profits from the 30th of June 2025 accounts, so i.e. those from the 1st of July up to the 31st of March 25. So you can see that for the 25 tax year end, in order to be able to accurately get the tax figures for the partners, the June 2025 accounts will need to have been prepared. So it is effectively bringing forward when the accounts need to be completed by. This may cause some particular issues for practices with some year ends. For example, a December account year end, the timing of it means that it is not practical to be able to prepare the December 25 accounts before the tax return needs to be completed. So what can happen is that you are allowed to make an estimate of the profits to be included until the accounts are actually finalised. But this does then mean that you are in the realms of then having to prepare revisions to tax returns, and there may be potential interest on tax payments due if the profits have actually been underestimated. So it could possibly lead to quite a large administrative burden, and HMRC have acknowledged this, and they're going to consult on some options to reduce the impact ahead of the transitional year. For some businesses, so other than GP practices, so for example, there's some large international businesses who have an account year end of the 31st of December, and they have that year end because it coincides with the year end for other businesses that they're doing business with on an international basis. So it's not actually practical for them to change their year end. So it's going to have quite a large impact on them. Now, this is from 2024-25. And as I said previously, is a transitional period for 2023-24. So what is this going to mean for us in practical terms? So in practical terms, this transitional year effectively has the same impact on partners as if they had changed their year end without requiring them to actually physically change their account year end. So within this tax year, partners are going to be taxed on profits for the 12 months for their normal accounting date, plus the period to the 31st of March. And then from this, they can deduct their overlap profits. So as an example, again, for a practice for the year end to the 30th of June, In 2023-24, the partners are going to be taxed on their profits for the 12 months to the 30th of June 2023, plus 9 months, of the profits up to March 2024, less their overlap. So there's going to be a bit of a bumper tax liability potentially for that year. Now, how much that is going to be dependent on the profits for that period from the account year end up to the 31st of March, and how that corresponds to the overlap profits. Because as I mentioned before, the level of overlap profits have been set at a period of time, and they may have been quite low when they were first generated, or alternatively, if partners have reduced sessions, then they could be relatively high. So it is going to be something that needs to be looked at on an individual partner basis. But it is something that is going to need to be planned for. Now, HMRC, again, know that this is going to be an issue for businesses. So they have said that any excess profits, so excess profits have been described as those from the account year end to 31st of March less the overlap. So they can be spread over a 5-year period. And the first year of that 5 years is for 2023-24. Now, if a partner leaves within that 5-year period, then this will bring all of the excess profit back into charge in the year that they leave. And because these excess profits can cause an anomaly to income levels, which could impact on allowances and means tested benefits, HMRC is saying that the excess profits can be treated as a one-off separate item in order to try and minimise that impact on individuals. So those are the changes. Those are some quite significant changes that are actually coming up. But as I said, we will be speaking to our clients about this on an individual basis. And for those of you who are not looked after by Lentils, then I would be expecting your accountants to be having discussions with you and the partners. So there's some practical aspects that we need to think about. So while the changes in the rules is going to remove a level of complexity regarding overlap, and it's possibly going to have a more clearer relationship between when profits are earned and when the tax is paid, because I know that particularly where we've got partners who have reduced sessions, there's quite a time delay between them reducing those sessions and them seeing the reduction in their profits. But it is going to have a significant impact on businesses and their advisors. So, for example, if a practice saves for the tax for the partners, then the partners are going to need to consider the impact of the cash flow. So that's going to be both on a practice basis and also on a personal basis. And that's going to be particularly pertinent in the transitional year for 2023/24. There might also be a consideration regarding the account timing and the year end, although, as I've already said, there is actually no legal requirement for practices to actually change their account year end. And it's also going to impact on the professional advisors. Most accountants will have quite a large proportion of their account year ends as March, but there is no doubt that some practices probably will want to change their year end to March. So that's going to mean that, just managing the additional work that is going to be required. Also, there's the extra work involved potentially with regards to estimates for profits and needing to revise tax returns. And actually, from a practice point of view, our clients are really, really good at getting information to us. So thank you all for that and for doing it on a timely basis. But some practices or businesses are not as organised as many of our clients are. And they can be used to actually getting their accounts information in a little bit later because you've got such a time delay between earning your profits and when you need to pay the tax. But businesses are not going to be able to do that anymore because of the need to know what the profits are at an earlier stage in order to be able to complete the tax returns. So that may mean a change for some businesses. And also, nothing has actually been mentioned about superannuation at the moment because this is purely a tax change. Now, superannuation certificates for the partners will normally follow the information that is on the tax return. What we don't know yet is whether that will continue to be the case. And then if so, partners will effectively trigger their overlap superannuation in 2023-24, which could then lead to some increased balance in payments. But nothing has been said about that, and we don't know whether there'd been any kind of smoothing of that in the same way that there is for the excess profits, or whether we can continue to prepare superannuation certificates based on the accounts. So, i.e. just following the normal accounts year basis. So that is something that, again, we will just need to be keeping an eye on. And once we know anything, we'll be sharing this with our clients.